Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 12th of December 2021, and we're looking at what is likely to occur during the FOMC interest rate announcement, which is due this coming Wednesday. So let's take a look. Now, yesterday we produced our gold and silver weekly update for the week ending the 10th of December, and we've placed a link to this below. We'll also be replicating the same video later today under a different heading and thumbnail, as we now have some rather conclusive evidence that many of our videos are not being promoted by YouTube when we mention our name in the title. Now, we predicted in the update that we expect that gold will trade this coming week between $1,725 and $1,825, with $1,700 to $1,850 as outliers, and silver to trade between $2,150 and $2,350, with $21 to $24 as outliers. We noticed that this past week gold fell $1 and silver fell 37 cents, and both really operated within relatively tight margins. We still see both under potential pressure this coming week, but all is dependent upon how hawkish the FOMC will be on Wednesday. Now, to some extent, an increasing of the bond buying program is expected. And if this happens, there will be downward pressure on gold and silver simply because there is likely to be a strengthening of the US dollar, where the index is currently standing at 96.09. That said, with the market already expecting such a move, then to some extent it has already been baked into the price, which is why gold at $1,783 is below the crucial 1800 level, and silver at $22.30 is below the important $23 level and the more crucial $24 level. Now, before we share our thoughts on what we believe is going to happen Wednesday, let's take a look at two short excerpts, one from CNBC and the other from ING, both of whom are expecting a stronger Fed action on tapering. CNBC article dated 10th of December, Fed is expected to speed up end of bond buying and signal interest rate hikes are coming. The Federal Reserve holds its two-day meeting on December 14 and 15. The central bank is expected to discuss speeding up the end of its bond buying program. If the Fed decides to taper its bond purchases more quickly, it could also begin to raise interest rates faster. Investors will be closely watching for the Fed's new interest rate forecasts. There is some important data due in the week ahead, including producer price inflation on Tuesday. The retail sales report is out on Wednesday, and industrial production will be released Thursday. In a testimony before a Senate panel on November the 30th, Federal Reserve Chairman Jerome Powell tipped the warning that the central bank would discuss speeding the taper of its $120 billion monthly bond purchases at the December meetings. His comments followed a parade of Fed speakers who all suggested the central bank could end the program sooner than the current timeline of June 2022. In the past week, stocks resumed their climb back towards highs after it became clear the Omicron COVID variant is unlikely to cause a shutdown of the economy. Pfizer and BioNTech also gave investors some encouragement when announcing that a study found 3 doses of their vaccine provides a high level of protection against the variant. End of article. ING website, thinking.com, dated 10th of December. What to expect from the December Federal Reserve meeting. The economy is growing strongly and inflation pressures continue to build. The Fed is alive to the risks and is set to announce that the QE program will end in February. This then paves the way for earlier and swifter interest rate hikes, Omicron permitting, with the Fed dot plot set to point to a minimum of 2 moves in 2022. QE, the end is nigh. The November the 3rd FOMC meeting saw the Federal Reserve call time on its $120 billion a month bond buying QE program. It announced that asset purchases would be reduced by $15 billion in November and by a further $15 billion in December, which meant that if the wind down continued at that pace, QE asset purchases would cease by the end of May. However, they also said that they could adjust the speed in the new year if warranted by changes in the economic outlook. That now looks to be the case. With households, businesses, politicians and virtually all the regional Fed presidents sounding increasingly anxious about inflation, Jerome Powell has signalled that he too thinks swifter policy normalisation is already required, as CPI moves to within touching distance of 7%. With no opposition raised by other Fed officials, despite the uncertainty presented by the emergence of the Omicron variant, next week's meeting looks set to see the Fed announce an acceleration in QE tapering, with a $30 billion reduction for January to $60 billion of purchases and a further $30 billion reduction in February. This would mean the Fed wrapping up the program by the beginning of March, leaving the Federal Reserve with $8.8 trillion of assets on its balance sheet, more than double its pre-pandemic January 2020 level. Now this part is really important to note. Even with the end of QE buying, the Fed's policy stance will remain highly stimulative, and in an environment of strong growth, decent jobs momentum and elevated inflation pressures, the case for withdrawing some of the stimuli appears strong. Admittedly, the emergence of the Omicron COVID variant is a cause for concern. Based on figures for restaurant dining and air passenger numbers, it appears that some consumer caution does appear to have kicked in, but so far the early signs are that it doesn't look set to prompt major new movement restrictions that will severely impact the economic outlook, at least in the United States. This uncertainty will be acknowledged in the statement, but with Jerome Powell having suggested that the transitory description of inflation should be retired, there are also going to be additional changes to the accompanying statement. They will acknowledge the upside surprises for inflation and the tighter jobs market, but are set to keep the longer-term inflation expectations remain well anchored at 2%, even if the consumer survey evidence and break-even inflation rates on treasuries are less categorical. Okay, we now know their thoughts, and frankly, we tend to agree with them. That said, there is one aspect that we also have to bear in mind. Until the outcome of Omicron is truly known, and its effects on our economic recovery, the Fed will be careful not to upset equity and financial markets too much, as it will not wish to be blamed for thwarting or even reversing that economic recovery we are currently experiencing. Well, a recovery at least according to the official figures. At the same time, for the Fed to remain credible, and its inflation target of 2% to be met at some time in the not too distant future, it cannot sit on its hands and do nothing. This is why the bond buying tapering is so ingenious, in that it allows the Fed to appear hawkish without severely affecting financial stimulus in the market by raising interest rates. And it perhaps is hoping that at least the threat of early rates will allow it to get away with a rather delicate balancing act, without actually doing it, at least for now. The danger, of course, is that if the Fed appears too dovish, the dollar will fall, inflation will rise further, but on the positive side, gold and silver prices will rise. So they have to combat inflation but not destroy the equity markets, which have rebounded this past week after 2 weeks of losses. In addition, we have to bear in mind the international pressure the Fed is receiving, as last week the IMF, the International Monetary Fund, called on the US Federal Reserve to move faster to end its bond-buying stimulus program and raise interest rates, as US gross domestic product nears pre-pandemic levels, amid a tight labour market and rising inflation. Also, Goldman Sachs analysts expect the Fed to double its pace to $30 billion in response to inflationary pressures. Our conclusion, therefore, is that the Fed will likely follow the path of increasing the tapering to end probably by March or April latest, and at the same time emphasize that if inflation does not retreat, then it will have to raise rates sooner than expected. If this does happen, we see gold and silver potentially dip further, but not too significantly. And if we're wrong and the Fed adopts a dovish approach, then we can expect a nice little jump. in both. What do you think they're going to do on Wednesday? Do share your thoughts. Meanwhile, thank you so much for listening. If you haven't already done so, please subscribe to our channel, not forgetting to press the bell sign so you're notified of our videos as and when they are published. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.